So coming to the book value method, the DCF approach and the relative valuation approach that we are going to discuss in the coming classes are the primary approaches used in corporate valuation. However, given the complexity and uncertainty characterizing the valuation, practitioners rely on some other approaches as well. Some of them are the book value approach, the stock and debt approach, the contingent claim approach, and the strategic approach. The book value approach relies on the information found on the balance sheet, typically adjusted to reflect the replacement cost. The stock and debt approach, which is also called as the market approach, relies on the observed market values of the invested claims on the company. The contingent claim approach, that is also called as option valuation approach, is used to assess the real options enjoyed by the firm, that is typically used as a supplement to the conventional DCF approach. The strategic approach to valuation builds value in terms of asset value, franchise value, and growth value, keeping in focus the strategic dimension of business. Coming to the book value approach, which is the simplest approach to value a firm, is to rely on the information which is found in balance sheet. There are two equivalent ways of using the balance sheet information to analyze the value of a firm. Firstly, the book value of invested claims may be summed directly. Secondly, the assets of the firm may be summed, and from this sum, non-invested claims like accounts payable and provisions may be deducted. So I will be illustrating this with an example in the class. Some people argue that book values on a balance sheet are more reliable estimates of value compared to value based on shaky future forecasts. Indeed, the original ideal of accounting was that the balance sheet would provide a reliable estimate of the value of the assets and equity in the firm. An article published in the Accounting Review in 1934, M.B. Daniels lays out this ideal as follows, that is, in short, the reader of financial statements usually believes that the total asset figure of the balance sheet is indicative and is intended to be so of the value of the company. He probably is understanding this value as what the business could be sold for market value, the classic meeting of the minds between the willing buyer and seller. Even accountants have struggled to put this ideal into practice. They have weighted the importance that has to be assigned to the historical cost of an asset in relation to its estimated current value and arrived at certain rules. For example, fixed assets are valued at original cost plus depreciation on account of use, and current assets are valued at cost or realizable market value, whichever is lower. However, they have failed in figuring out how to value intangible assets like brand equity and technical know-how, so they have by and large chosen to ignore the intangible assets. Now, the question is, when can the book value to be a good proxy for true value? For a tangible asset with limited or nil growth opportunities and no prospects for earning superior returns, book value is a better value which gives a real value, or it may be a good proxy for real value. For a firm with considerable growth opportunities and potential for earning superior returns, book value will diverge significantly from the true value. The accuracy of the book value approach depends on how well the net book values of the assets reflect their fair market value. There are some reasons why book values may diverge from market values. Inflation is one of the reasons which is responsible that the book value of an asset and its current value of an asset differs. Organizational capital, that is, which is a very valuable asset, will not be shown in the balance sheet. Organizational capital is the value created by bringing together employees, customers, suppliers, and managers in a mutually beneficial and productive relationship. Organizational capital, which is one of an important characteristic, which cannot be easily separated from the firm as a whole entity, is not taken into consideration in the balance sheet, is one of the reasons why the book value differs from the market value. So, and we also will discuss the adjusting book value to reflect its replacement cost. Even though an asset's earning power is not reflected or related in its book value, especially if the asset is old, it is likely to be related to its current replacement cost. Hence, book values has to be substituted by current replacement cost. So the various assets that are valued are cash, debtors, inventories, other current assets, fixed tangible assets, non-operating assets, and all these have to be adjusted to its book value to reflect the liquidation values. And there is one more method, that is adjusting book values to reflect the liquidation values. The most direct approach for approximating the fair market value of the assets on the balance sheet of the firm is to find out what they would fetch if the firm were liquidated immediately. For example, if there is an active secondary market for the assets, liquidation values are equal to secondary market prices, but if the active secondary markets are absent for many business assets, in such cases, the appraiser must try to estimate the hypothetical price at which the assets to be sold. This is one of the principal weaknesses of this approach, and it ignores organizational capital. Instead of valuing the firm as a going concern, it values it as a collection of assets to be sold individually, and this approach makes no sense if the firm is worth more alive than it is dead. That is, I mean to say, this approach makes sense only for a firm that is worth more dead than alive. The unadjusted book value approach makes sense only in rare cases like appraisal of regulated industries. The adjusted book value approach, replacement cost approach, or liquidation value approach makes sense for firms which derive their value mainly from owning tangible resources. Even in such situations, most firms have valuable organizational capital, and in most real-life situations, the book value approach has a limited applicability. So we also will discuss the adjusted book value approach. in detail with an example. And the market approach or the stock and debt approach. When the securities of the firm are publicly traded, its value can be obtained by adding the market value of all its outstanding securities. This is a simple approach to valuation by the property tax appraisers, and this approach is also called as the market approach. For example, if a company's outstanding shares is 1.5 billion and the closing price of its share is 20 rupees on a particular day, its market value, that is, it has the market value of its equity of rupees 30 billion. And on the same day, the firm also had an outstanding debt with a market value of 21 billion rupees. The stock and according to stock and debt approach, if you add the market value of debt and the market value of equity, a total firm value will be rupees 51 billion, and this itself is the value of the firm. Coming to the efficient market hypothesis. The stock and debt approach assumes market efficiency, but is not exploring the idea of efficient market hypothesis to apply stock and debt approach. An idea that has been introduced by Eugene Fama as efficient. Put simply, the idea is that the intense competition in the capital market leads to fair pricing of debt and equity securities. No wonder it continues to stimulate insight and controversy even today. An efficient market hypothesis is referred to as credo, a statement of faith and not a scientific proposition, by Benjamin Friedman. Warren Buffett, perhaps, who is the most successful investor of all times, has characterized the market as a slough of fear and greed, untethered to corporate realities. For most financial economists, however, the efficient market hypothesis is a central idea of modern finance which has a profound implications. Now, what is market hypothesis? What is efficient market? An efficient market is the one in which the market price of a security is an unbiased estimate of its intrinsic value. Market efficiency does not imply that the market price equals intrinsic value at every point in time, but still, most of the times it is an unbiased estimate. All that an efficient market says that the errors in the market prices are unbiased. The errors in the prices are not due to the biases, which means the price can deviate from the intrinsic value, but the deviations are random and uncorrelated with any observable variable. If the deviations of market price from intrinsic value are random, it is not possible to consistently identify over and undervalued securities. Market efficiency is defined in relation to information that is found in the records of the past. It is defined in relation to information that is reflected in security prices. And according to the suggestions by Eugene Fama, it is helpful to distinguish the market efficiency into three levels: weak form efficiency, semi-strong efficiency, and strong form efficiency. In weak form efficiency, prices reflect all information which is found in the records of past prices and volumes. Semi-strong form efficiency. Here, the prices reflect not only all information found in the record of past prices and volumes, it also reflects all other publicly available information. And strong form efficiency, prices reflect all available information, public as well as private. But there are some misconceptions about this market efficiency hypothesis. That is, this is the misunderstood. Some of the common misconceptions about the efficient market hypothesis are: the efficient market theory implies that market has perfect forecasting abilities. Yes, this assumption is true, but the efficient market theory merely implies that prices impound all available information. If there is any errors in the prices, it is not due to the information that is reflected in the prices. It doesn't mean that the market possesses perfect forecasting abilities. And one of the misconceptions, as prices tend to fluctuate, they would not reflect fair price. That is, we all know that the prices will not remain constant. Prices of the shares will be fluctuating. When this fluctuation happens, then it will not reflect the fair price. That is one of the misconceptions. But unless prices fluctuate, they would not reflect fair price. There should fluctuation happen. There may be some information incorporated at that moment, and hence there may be a price fluctuation. Future is uncertain, market is continually surprised. Prices will reflect these surprises as they fluctuate. And one more misconception is inability of institutional portfolio managers to achieve superior investment performance, which implies that they lack competence. That is, we presume that the portfolio managers are very much capable of finding out the prices, or they are very much capable of achieving superior investment performance. But in an efficient market, it is ordinarily not possible to achieve superior investment performance. Market efficiency exists because portfolio managers are doing their job in a very well manner in a competitive setting. It is not that portfolio managers are inefficient or they are incapable of achieving perfect or superior performances in the market. It is not that they lack competence. It is because of the portfolio managers there is an efficient market. There is an ability to perform superior investment or to achieve superior investment performance in the market is possible because they are doing their job well. And one more misconception is that the random movement of stock prices suggests that the stock market is irrational. So randomness and irrationality, they are two different matters. If investors are rational and competitive, price changes are bound to be random. So there are evidences in favor of efficient market hypothesis. So, and the three important predictions of efficient market hypothesis are: if security prices reflect all publicly available information, when even professional investors cannot earn superior risk-adjusted rate of return. Since the current stock prices reflect all currently available information, price changes only in response to new information, which is by definition is unrelated to previous information, because new information cannot be predicted in advance. Price changes too cannot be forecasted in advance. Hence, prices behave like a random. And the third evidence which supports efficient market hypothesis is stock prices respond immediately and unbiasedly to new information. Suppose Tata Steel announces unexpectedly lower earnings, and as a result the stocks drops from 525 rupees to 500. As per efficient market hypothesis, the decline should occur immediately following the announcement. If the drop occurs gradually over several days, or should the market overreact and then recover, it is not due to efficient market hypothesis definition. As per the definition, the decline should occur immediately following the announcement, not gradually over several days, nor it overreacts, then recover gradually. There are a number of event studies which has examined the response of stock prices to announcements regarding earnings, bonus issue, dividends, takeover bids, and so on. By and large, these studies have found that stock prices respond immediately and unbiasedly to new information. There are also evidences against market efficiency, like the bulk of empirical evidence supports the market efficiency. A number of inefficiencies also have been found, which fall into three categories like pattern in stock prices, mispricing of securities, and excess volatility in stock securities or stock returns. That is, researchers have found some seasonal patterns, which is the one well documented pattern is day of the week effect. That is, stock returns tend to be lower on Mondays than during the rest of the week. And another puzzling calendar anomaly is the January effect. Stock prices seem to rise more in January than in any other month of the year. And one more evidence that is against market efficiency is mispricing of securities. There is an empirical evidence which suggests some mispricing of securities. That is, few have found that investors in small firms have earned significantly higher returns than investors in large firms after adjustment of risk. And a number of studies also have been found that value stocks with high bond value to stock prices ratio and low price earnings ratio tend to outperform growth stocks. That is, stocks with low book value to stock price ratios or high price earnings ratio. Excess volatility in stock returns. There is an evidence presented by Robert Schillers that stock prices jump around much more than what is justified by variations in corporate dividends and cash flow. That is, the stock market crash. For example, in October 1987, when Dow Jones Industrial Average fell by 23% in one day, provides the most dramatic evidence in support of Shiller's hypothesis. There was no new fundamental information to justify such a dramatic decline in stock prices. Hence, the idea that market prices reflect intrinsic value appears less appealing. Where, that is, were the price irrationally high before the Black Monday or irrationally low afterwards? So, we will be discussing in detail with illustrations about the book value approach to valuation, which a layman can understand as soon as he looks at the balance sheet of a company about what is the value of a company, and also the stock and debt approach, which is also called as the market approach, which is supported by market efficiency theory, that the value of the firm according to this approach is the total of the value of the outstanding shares and also the value of outstanding debt is the value of the firm as the price. Market price reflects all the available information about the company, that is, whatever the information that is recorded in the balance sheet, whatever the information that is known to the public or which is publicly available, all such kind of information is reflected in the market price, and hence that is the true value of the firm, which is supported by the market hypothesis theory. So this will be discussed in week 4 in different sessions.